start recording. So I did just want to provide a very quick update before we got started with the director's cut today. I'm sharing on my screen, and then included just on the front page is just a brief update, just in relation to the COVID-19 updates. So for Department of Mineral Resources, oil and gas hearings will proceed as scheduled. You can listen to any of the hearings live online. And any other questions you can submit to the Oil and Gas Division if you have any other questions related to hearings. We've gotten a couple questions related to guidance on the Industrial Commission meetings. You can reach out to the North Dakota Industrial Commission or visit their website for any updates or any changes related to meetings there at the Capitol building. If you are an operator listening in or watching this back and you have questions related to reporting or forms or anything else related to compliance with the North Dakota Oil and Gas Division, you can check out the forms page on our website. There's a lot of guidance there on how to submit reporting online, or again, contact our office. And then lastly, of course, just the North Dakota Department of Health, of course, the CDC have a lot of great information related to the coronavirus, and any updates related to that in particular, please reach out to the Department of Health and all of their public information folks, and they're happy to answer questions and provide guidance from there. And with that, I will kick it over to Lynn for the director's cut and production.
Wow, thank you, Katie, for that rosy, sunny introduction. And as Katie said, we're following the North Dakota Health Department guidelines with regards to hearings, and at this point, the situation's normal. So we'll just see how that goes. Our hearings are scheduled for, is it Wednesday and Thursday of next week?
Yes.
Yes. Okay. So here we are, March of 2020. We're talking about January production. And in today's climate, that seems like ancient history, doesn't it? So looking back at January production, which is the latest we have, we did see about a 3% drop in crude oil production. Along with that, natural gas production dropped only 1.5%. So back to that theme, as companies began to shrink their activities back into the more core areas of the Bakken, we were already seeing some pressure on crude oil prices at that point in time. And so we had already seen drilling activity, rig counts drop into the low to mid 50s. And so there was retraction more into the core area of the Bakken, higher gas oil ratio. And so the new wells being drilled and completed, producing more gas on an individual well basis. So we saw crude oil decline, not a large decline, about 3%, but natural gas actually declined significantly less and continued to apply pressure on the gas capture requirements that we have as a commission. So I'll talk about those in a few minutes. Obviously, the big story is when we talk crude oil prices. So when we look back to January, we were starting to see pressure on crude oil prices as the COVID-19 thing began to ramp up, and we were starting to see some signals. You heard me talk about it last month. We were seeing signals that China, their economy was ramping down pretty rapidly, and that was going to impact world crude oil supplies. What I did not expect, and what I think no one expected, was that the first week of March, OPEC would meet to talk about what to do about that situation, and that they would walk away having canceled out a 3-year agreement that they had, which was implementing price or production cuts for the OPEC countries as well as Russia that were helping to support crude oil prices. So just less than 2 weeks ago, they completely walked away from 3 years of history that they had in working to support crude oil prices in the $45 to $50 range. The bottom has just dropped out. And so we're seeing even today, West Texas Intermediate's below $30 a barrel. North Dakota Sweet is below $20 a barrel. Those numbers don't in any way, shape, or form reflect break-even prices for any but the core area of the Bakken. And so we are looking at a situation very much like what we saw in early 2015. At that time, we went into that with 185 drilling rigs, and we dropped down to 27. We're going into this one, today's rig count, 56. We're looking at similar kind of numbers probably at the bottom of the cycle. I've been talking with some companies. You probably saw one of our major oil and gas companies today announce that based on capital requirements in West Africa, they're going to have to take their North Dakota rig count from 6 down to 1. Some others have talked about 50% reductions in those kind of neighborhoods. And so we talked in February, having come back from Houston, about the fact that all of our companies were being forced by investors to operate within free cash flow. Well, what we've seen is their free cash flow has been slashed by 50 to 60%. So it's just completely logical that capital expenditures in drilling and completions have to go the same direction in roughly the same amount. And so that's just what we're looking at probably over the next 3 months or so, is working our way down to half or maybe slightly below half of the rig count that we started all this at 55. It's not great news at all. And so you can already begin to see it in the January numbers. Wells waiting on completion went up by almost 70. And inactive wells increased by almost 700. And so the pressure of winter weather, lower prices, and the direction the market was heading was already applying a lot of pressure on the marginal wells, or wells that hadn't had the investment to complete them yet. Next week, we're going to be talking with the Industrial Commission about restarting the inactive waiver and non-completed well waiver policies. I think, the commission needs to send a signal to the industry and to the markets that it doesn't make good business sense to force North Dakota Bakken crude oil into a market that's clearly priced well below break evens and below really what long-term world demand says the market should be at. So we're going to be having that discussion with the commission next week. We'll see how that goes. Interestingly enough, as we look at the January numbers, we see activity on Fort Berthold kind of moving the opposite direction again. We went back up to 13 drilling rigs operating there, and down to 78 wells waiting on completion. And so moved in the opposite direction. And you can really see that when we start to move into gas capture numbers. It impacted in a negative way the gas capture numbers for the Fort Berthold fee lands in particular. So I'll kind of end there. Gas capture continues to ease its way upwards towards the 88% goal. I would anticipate with production dropping that we're going to achieve that goal. I think the commission is very committed to moving away from the more liberal waiver policy that we had for gas capture, and actually it's not a bad thing to have production limited or self-restriction in a time like this. It's relatively easier for many of the companies, and so we'll be having that discussion too, probably starting in April with the Industrial Commission. As you look at the gas capture numbers, like I said, marginal improvement from most of them, although the fee lands on Fort Berthold went in the opposite direction. That's largely because some really great wells completed on the fee lands on Fort Berthold Reservation, and so it drove those gas capture numbers down. I do know from anecdotal information, and this is just reports from the 8 or 10 companies that we met with in the interim here with regards to midstream companies and operators concerning their gas capture, that we had somewhere between 70,000 and 100,000 barrels a day restricted production in an effort to improve gas capture. And so not all operators were doing that. We'll be analyzing that to see if any of them need to be restricted under the commission regulations. But I do know that 3 of our large publicly traded operators were self-restricting, and it falls somewhere, like I said, between that 70,000 and 100,000 barrel a day number. So well above the amount that we saw production decline. And so you could actually attribute all or more than the production decline we saw to those restrictions. But we also know that companies were beginning to see the pressure of downward prices. I think on the positive side, there's a lot of hedges in place. So a lot of our operators have the majority of their crude oil hedged for 2020. That means they're still going to be getting $50 or $55 a barrel. Even in this market, somebody is losing a lot of money. Whoever sold those hedges to our operators. That's going to help cushion us through this year. But as far as I know, there's no hedges going out into 2021. And so it's just impossible to predict at this point how long this price war is going to go on. There has been no movement on the part of Saudi Arabia or Russia to end the price war at this time. It's just too early to tell. Just a couple of things on the federal front. One is that the Industrial Commission, as you know, at their earlier March meeting, March 9th, submitted comments on the right-of-way waivers for the Bureau of Indian Affairs. We need, and that especially shows itself in these Fort Berthold gas capture numbers, we need to make sure that infrastructure keeps moving forward to capture gas on Fort Berthold. And if that waiver expires on April 5th, that's going to just stop infrastructure construction on Fort Berthold. And then the other thing is, as you know, the Council of Environmental Quality has published for comment changes to the NEPA rules and regulations. And so the Industrial Commission submitted comments in favor of that. But really the big news of the day and of the month is what happened first week of March in Vienna, when a 3-year-long deal between OPEC and Russia just fell apart. And so we are in a price war. I call it every man for himself. We have Russia, Saudi Arabia, and the United States all producing well over 10 million barrels a day. And it's too early to tell who's going to blink first in what's happening out there. So we'll take some questions.
Any questions in the room?
So the inactive well count jumped, as you said, a ton, almost 700. Is that concerning to you? And then can you talk about, you were talking about how the Industrial Commission is going to maybe revisit some of its waivers around that. I'm not familiar with the waivers that it has for that. Can you talk about that?
Yeah, so the question was the inactive well count and Industrial Commission revisiting its waiver policy. In 2015, when the oil prices collapsed, there was a lot of concern that marginal wells would get prematurely plugged and abandoned, and that we would hurt the long-term prospects for enhanced oil recovery and for recovery from the price collapse. So the commission implemented a policy that inactive wells would not have to be temporarily abandoned or plugged and abandoned after 1 year in that category, like they are currently today as abandoned wells. It is a concern, and as we know, inactive wells and abandoned wells are a huge concern long-term for the Industrial Commission. So we're looking at what we're really going to be studying between now and next week's meeting is what should be the trigger for taking that waiver policy off. If the commission implements it, what's the oil price where that should go away again, and we should expect oil companies to post single well bonds or plug those wells. And so that's what we're going to be looking at really hard is there an oil price trigger? Is there a time limit on that policy? But what we don't want to have happen is wells that have potential for refracturing or something like that ending up prematurely abandoned. And so we'll just kind of take it a month or a year at a time, but it is going to expand the inactive well count. That's the downside of it, for sure. On the other policy, the one that's a lot easier to deal with is wells that haven't yet been completed. So they've been drilled to TD, all the pipes been installed, and a company may choose to not spend the capital to complete that well, to frack it and bring it on production at this point in time. And so, those are brand new wells, and they're not going to end up as abandoned wells at some point in time soon. And so we'll for sure be promoting that in terms of waiving that requirement that those non-completed wells be put on production.
I'm sorry, we have to grab the microphone.
Yeah.
You had a question?
That's at 4:15.
Yeah, but we like to go live beforehand.
Okay, got it. Understood.
Yeah.
Yeah, my question is that the Revenue Advisory Committee was going to meet Thursday. They've canceled that. That just leads to the question, how could this potentially affect the forecast?
Yeah, great question. So how does this potentially affect the revenue forecast? And we're very concerned about making an accurate forecast update for the remainder of this biennium. So we did have a phone call with Moody's. The conclusion from that phone call was that there are so many variables at play right now that in order to make any kind of a reasonable or realistic forecast for the rest of the biennium, we should hold off for a month or 6 weeks and let a bit of dust settle. What it appeared is that the Chinese virus situation has peaked and has headed the other direction, and that Chinese manufacturing is restarting. What we don't know is the time frame for those goods to be allowed through ports into Europe or the US. And the US virus outbreak, or the European virus outbreak, has not peaked yet. So once that happens, we'll have a much better picture of what the future looks like. So I guess I would say that it's been postponed for 4 to 6 weeks, not canceled, from the standpoint that there are just too many unknowns for people to have any kind of a rational discussion about what the forecast ought to look like. These prices clearly are drastically below the revenue forecast. Production remains above, about 30,000 barrels a day above, but that's the equivalent of only $1 to $2 of oil price, and prices are more like what, $20 below. So significantly below revenue forecast, and one would think there's going to have to be adjustments. It's just that we need a little more time to digest all the variables and try not to have to make a series of closely spaced adjustments, but just make a few.
If we see drilling start to slow down and ultimately production starts to, taper off a little bit, does that ultimately bode well for flaring?
Yeah, so the question was, does a slowdown in drilling and decrease in production bode well for flaring? And the answer would be, it certainly does. What you see in the flaring statistics is that the last time that this happened, gas capture got above 90%. And so it does take the pressure off in the short term. Now, I will say in the long term, it can become problematic. So what you saw pretty quickly as the markets really, I hate to use the term overreacted, but I think that's what they did. Even stocks like ONEOK took a hit. And so they were forced to postpone some of their capital expenditures, which means then gas capture infrastructure, like the Demicks Lake plant or the expansion of Elk Creek natural gas liquids pipeline, get postponed. And if too much of that happens, we get behind the curve again. And that's where we got to last time. So in the short term, it looked great in gas capture. In the long term, it creates even bigger problems as you come out of the low prices.
Is there any chance, I hate to bring this up, is there any chance that we could see oil production drop below 1 million barrels?
Great question. Is there a chance we could see oil production go below 1 million barrels a day? We've looked at a large number of scenarios, price scenarios, and none of them take us below 1 million barrels a day in the next 4 or 5 years. So it's highly, highly unlikely. There's always, never say never in the oil and gas business, but it's extremely unlikely that this goes on long enough to drop us back below 1 million barrels a day. The real pressure from what we can see is going to be on Permian. They're coming. The Permian Basin is at the same point right now that North Dakota was at in 2015, where the leases are essentially held by production and companies can make CapEx investment decisions based on cash flow and profitability. They're not forced to invest in wells that'll lose money just to hold really expensive leases. That's behind them. So they have the freedom to reduce production much more drastically than they would have, say, 2 years ago. That's good news for us. The other piece of good news, competition-wise, is that the vast majority of our 3 million a day of exports, probably 2.5 million of that or more, are from the Permian, not from the Bakken. And it's the 3 million a day of U.S. exports that are going head-to-head with Russia and Saudi Arabia. So those are going to be the most vulnerable barrels. And those most vulnerable barrels are Permian barrels. So relative-wise, we've got some competitive strengths, but we're still looking at cash flow falling 50 to 60%, and that has to reduce activity. It can't help but reduce activity in a similar proportion.
And I have a question. At these prices, whether it's large operators or small operators, should we look at any bankruptcies or anything along those lines? Can you explain how that process works, how we handle that on the state in regards to abandonment of wells, plugging in reclamation?
Mm-hmm. Yeah, so great question. And these are the types of events, we call them black swan events, that really can drive small operators, especially people that have been operating some of the marginal, more conventional assets, into bankruptcy. And we saw that with the last price collapse, and we fully anticipate that we'll see that now. We have implemented programs or processes to monitor the bankruptcy courts and to intervene so that we can intervene in those bankruptcy cases and make sure that judges don't award assets to a bankruptcy takeover and leave the state with the liabilities. We have also been ramping up bonding requirements on some of those more marginal properties. What happens in those cases typically, and with our new rules that are going into effect April 1st, those well transfers of abandoned wells are going to have to be supported by single well bonds for full plugging and reclamation. So if a bankruptcy court awards assets to an operator that wants to take over those assets, they're going to have to post surety bonds to cover plugging and reclamation costs for any abandoned wells that transfer to them. So we've taken a lot of steps to insulate the state and the taxpayers from that downside. I think the other good news is that we have built an account, the Abandoned Well Site Restoration Fund. We've got pretty close to $25 million in there. And so we have the capacity to handle a major bankruptcy and any liabilities that might leave the state with. So we've got processes to monitor the bankruptcies. We've got processes to require bonding as the wells are transferred. And we have a process for covering any significant problem wells in the interim. And that's about the best we can do. Ultimately, we might end up confiscating wells and using that fund to plug them to make sure that any environmental issues are covered.
I wish I had one more positive, uplifting question to ask.
Yes, let's ask one.
One was just to confirm, I guess, is where do we think maybe that rig count will go in the next couple months? And then the second follow-up question they had was just in regards to, I guess, future for employment in oil and gas fields. Have you heard anything or anything of that nature? What could come?
So in a lot of respects, it depends on how deep and how long this goes. I think we're seeing the how deep, and looking at today with West Texas Intermediate below $30, we're probably at or very near the bottom. What we don't know, we've got a couple of previous situations that we can look at that give us an idea of how long. So the 2008 price collapse was a couple of years, 2.5 years. 2015 was 2.5 years. 2001, which some people believe this is more like the 2001 recession and price collapse, recovery was within about a year. But that's a best case scenario. So our best case scenario is 1 year, and our other scenarios are 2.5 years. So we're in this for a protracted period of time. What we've seen in the employment area is that all job offers are off the table. So Job Service North Dakota has seen that all of the hiring that was out there, the attempts to hire for oil and gas industry has been pulled back, and companies are looking at their cash flow and their bottom line to see what they have to do. Some of the industry sectors are a lot more vulnerable than others. Obviously, drilling, very vulnerable. Completions, hydraulic fracturing, very vulnerable. Gas processing, we have to have it. In fact, it's continuing to grow. Saltwater disposal, steady to growth. And so there are some aspects like infrastructure, and I'm trying to end on a positive point. So there are absolutely some sectors like gas processing, saltwater disposal, and pipeline construction that are steady or actually still growing slightly. But a couple of the major employment sectors, very vulnerable, and we're going to look at 50-60% retraction.
I think on that note, we'll
Thanks,
transfer
everyone.
over to Justin.
Well, good afternoon, everyone. Justin Kringstead, Director of the North Dakota Pipeline Authority. We're going to get right into the production update from the neighboring states. So we do have some year-end information now for 2019 from Eastern Montana as well as South Dakota. So wrapping up 2019, about 1.53 million barrels per day within the U.S. portion of the Williston Basin. So we'll keep that in mind as we look at projects, talk about projects and transportation impacts of the total picture, and not just North Dakota, even though it does make up the bulk of the production in the region. And then 2020, you did hear the update from Lynn. We'll continue to fill this in as details emerge from our neighbors. Just taking a quick look for reference of what our month-to-month changes looked like for both crude oil and natural gas. And so the crude oil, now third month in a row of decreases, 2 solid months of production decreases. I look back historically, it's been a while since we've had kind of back-to-back large production drops like this. And again, it is, in my opinion, almost exclusively weather related. Again, we hadn't had the big major price collapse at that time yet. So I am anticipating that as we move into February, even into March thus far, has looked pretty positive. So I am expecting to see some production turnarounds here as the February and March numbers start to emerge. Just a quick update on transportation. Some minor shifts again between that pipe and rail primarily. It's a little bit easier to see on slide 6. We did see the pipeline share increase just slightly and a small decrease in the crude by rail market share for the month of January. We did also see in January a slight price slide in that Brent WTI. And we're going to talk about that here in a moment because there's been some pretty big shifts in the market here in the last week and a half on that Brent WTI as well. And then again, just month to month, just a slight decrease in expected volumes of crude by rail, again, coinciding with the overall statewide production decrease, that market share of crude by rail, just again, a slight decrease around 300,000 barrels per day. And then we have some year-end estimates from the EIA as far as the destination for that crude by rail. We did see PADD 5 take over again in the month of December as the primary destination. So again, the west coast of the U.S. and the east coast almost hand in hand, volume and market share wise. And again, as we go into 2020, the first quarter, second quarter, I don't expect major shifts, at least in the first couple months. As we get into March here, I'll talk in a moment about what we're seeing. Pricing as of December, again, PADD 1, PADD 5, highest price, coinciding again with that rail access option. So here we are. This is a pricing as of this morning, and so it's even shifted down further, weakening by this afternoon. You look at the difference there between the Brent WTI. This morning it was less than $1. Late this afternoon it was about $1.60 or so, but again, much tighter price spread between those two major benchmarks than what we've been seeing over the last 6+ months. And so again, $5 to $6 is that threshold where I start to see and seeing the numbers and estimates that more barrels are being moved by pipeline. When that price difference is less than $5, when it exceeds that $5 or $6, we start to see rail be the primary destination. So as we get into March, April, if this narrow spread continues, we'll likely see market share, the pipelines filling up and going to the more traditional Midwest and Cushing marketplaces, and then excess barrels that are that have that flexibility from a marketing perspective, getting onto the rail cars and going to the coastal areas. I expect this to be very fluid going forward. You know, right now, Cushing, at least before this afternoon's reports came out from the API and the EIA tomorrow, Cushing didn't have a lot of pressure as far as congestion as of earlier this week. As production in the U.S. stays robust in the coming weeks and months before the retraction really takes hold, I do expect that Cushing storage volumes will start to fill up, and we may start to see that spread widening again. Again, there's congestion worldwide at this point. Again, there really isn't a market right now that has a real strong demand for crude oil, and so production's having to find a home, whether that's waterborne storage, traditional tank storage, or if in the case that we might see in the coming weeks and months is keeping the wells uncompleted if that's an option for some producers. So again, we'll keep an eye on this. It will drive marketing decisions out of North Dakota going forward. The truck rail movements, imports, exports, again, very high volumes on the imports coming through North Dakota. Again, the bulk of those volumes are passing through our border ports. I don't anticipate a large percentage of that staying within the border and getting on one of our transportation systems. Then switching gears to natural gas, again, Lynn alluded to the decrease in gas flaring. We're seeing that in the numbers here in the breakdown. Where we saw the biggest decrease was in that orange piece. So again, wells that were connected but flaring, as we've had additional plant capacity come online in December, January, wells that were connected but had congestion at one point along the system, we're seeing some of that start to ease up, and I expect that going forward, we'll continue to see, in particular, that orange piece of the puzzle continue to shrink. And then moving to slide 14, again in January, slight difference between the number of new wells producing gas and selling gas. Fairly close, and we'll keep an eye on that. Obviously, as we work through winter, that's a tough time for construction and getting into the load restriction season that we're currently in right now. Winter, spring are always tough from a pipeline construction perspective, and we do anticipate that as we move into the warmer, drier weather, things will improve again. Here in a moment, you're going to see my updated, every month I put out my natural gas production forecast, and so I just wanted to just very quickly let everyone know what's behind that. It is oil price driven for the natural gas production in North Dakota. So earlier this month, the EIA had updated their March short-term energy outlook, and you can see that they're anticipating in the next several months going from $30 on a monthly average, and then starting to increase into the $40+ into the next year. Again, a lot of things moving right now with this, and so I just want you to know that when you see on slide 16 what my natural gas production forecast looks like, just know that almost daily these are getting updated as new price information and details are emerging. So the expectation is that as we move into the summertime and we start to catch up with some of the decreases in activity, that crude oil production will start to level off and decline. But at the same time, at least in the scenario modeled here, we do see natural gas staying a little bit more robust, and we've seen that historically. Again, the rate of natural gas production versus crude oil natural gas has the ability to produce at higher volumes, even when crude oil is going down. So, depending upon the duration, natural gas isn't expected to drop as quickly as crude oil. And then once there is some type of price rebound, that we do expect that natural gas production, as well as crude oil, would start to rebound going forward. You will also notice on this graphic that blue piece, the suspended gas plant capacity, that is back on the graphic now. We did have one announcement from One Oak. The Demicks Lake 3 plant has been suspended for the time being until, again, there's some more market clarity on what the appropriate timing for that project will be. That's the only one publicly available right now, and we'll continue to monitor all the companies that have existing projects and planned projects here for the region. And then again, long term, there was a question earlier about what this means for North Dakota's gas flaring, and I think Lynn nailed it right on the head by saying that, again, in the near term, it looks positive. Long term, it becomes challenging from a midstream perspective. Obviously, you don't want big market swings, you want certainty. And so as companies are looking at the future and trying to develop projects and understand the scale and the timing of those, any uncertainty is not a good thing. And so events like this add a whole nother level of uncertainty and complexity to the issue. And going forward, we know how critical the timing is of gas infrastructure. So more hesitancy typically results in additional flared gas in North Dakota. So near term, Lynn was right, it's going to be positive. Long term, it just adds another level of uncertainty and complexity for the industry. So with that, I'd be glad to answer any questions.
With the North Bakken expansion from WBI.
Yep.
It looks like everything looks on track for construction to start in 2021, finished by somewhere October, November 2021. Do you have any thoughts about how that's going to affect the flaring situation?
Yeah, so the question was the North Bakken project, WBI, basically connecting the Tioga area and gas plants surrounding Tioga with the Northern Border Pipeline south in McKenzie County. So that system right now, as we sit here today, that northern portion of WBI's system, north of Lake Skakwe is full. They cannot take additional gas onto that system today. So any type of growth or new volumes that want to come into gas plants up there, it cannot happen until that expansion takes place. So that project will allow additional gas processing, additional residue gas, then to have an egress option for north of Lake Skakwe. So it will allow north of the lake production the outlet it needs for further gas capture.
This is probably a question it could be for either of you, frankly, but I just pulled up the oil prices and I've been watching WTI hover at 26.82 and now it's at 26.85. Back in, I think, 2016, early 2016, when oil prices were at rock bottom just a couple of years ago, do you know what they bottomed out at?
I don't off the top of my head.
Okay.
No.
I can look it up.
We can get that for you.
Yeah.
Sounds good.
Earlier, I asked you about something that somebody sent to me in a railroad magazine saying that they're looking at transport of NGLs via rail. Have you heard anything more about that?
Yes, so natural gas liquid. So the question was about NGL by rail. And so there was a period of time up until December when the Elk Creek system came online that North Dakota was railing roughly around 100,000 barrels of NGLs per day out of the region. Our natural gas liquids production exceeded our pipeline capacity. Once Elk Creek came online in December, that alleviated that need for NGL by rail. There's likely still some of that taking place. There are some products, purity products, whether it's propane or butane, that still will use rail as its transportation option, but by and large, the bulk of the Y grade and things will now go on Elk Creek.
Any additional questions for Justin in the room?
Okay.
All right.
Thanks.
Well, thank
Thank
you.
you so much for joining us.